Hi students. In case of a company, what happened? There is a 40% of the chances that the bills of services are defalcated. When these bills are prepared, there is 40% of the chances that there will be some errors in this bill. And the internal control is able to prevent 75% of these defalcations in the preparation of bills. 75% they are able to detect it. Further, when the auditor he applies the audit procedures, so 60% of the time he will detect all these material misstatements. So he is able to detect at least 60% of the items. With this given data, you have to find out the audit risk. Now, audit risk is a risk of giving an inappropriate opinion on the financial statement. You say it's an unmodified opinion, but it is a modified opinion. That is known as the audit risk. Audit risk is made of two components. One is the inherent risk and one is the control risk. Inherent risk is the susceptibility of an assertion to misstatement where on the account balance, on class of transaction and disclosure and presentation, which arises actually here, and when there is no internal control, where there is no internal control, so there's no internal control exist. Whereas control risk, where the internal control is unable to detect, prevent, detect, and correct the material misstatement at an assertion. So they are not able to prevent, detect, and correct the misstatement. Further, what happens is that when we talk about the what you can say the detection risk is something where the internal control is unable to what you can say the is where the auditor is conducting the audit and he is unable to detect prevent any misstatement. Actually, that is called as the detection risk. So auditor misapplies the audit procedures or he misinterprets the audit result. That is known as the detection risk. So considering all these factors, now let us calculate the audit risk. As I told you, audit risk is a combination of risk of material misstatement and the detection risk. Detection risk, again, risk of material misstatement is made of two things, that is inherent risk and the control risk. So risk of material misstatement means there is a material misstatement in the financial statement before the commencement of audit. So when I talk about inherent risk, see here there is a 40% of the chance that when the bills of services are generated, there is a misstatement. Means it's a inherent risk. It is unavoidable. It's inherent risk. 40% of chances. Now, what happens? What is the control risk? See, 75% of the time the controls are operating effectively. It means that 25% of the time they are not operating effectively. So the control risk is 25%. Here the inherent risk is 40% and the control risk is what you can say 25%. So if I want to calculate the risk of material misstatement, which is nothing but a combination of inherent risk into the control risk, so there 40% into 25%. So I can say 0.4 into 0.25. I'll get the answer as 0.1. 0.1 means 10%. So it means that 10% of the chances that there is a risk of material misstatement in the financial statement, 10% of the times there is a material misstatement. That is a risk of material misstatement before the commencement of audit. Now, we said that 60% of the time the auditor is able to detect the misstatement. It means 40% time he cannot detect. So that 40% it becomes a detection risk. Means you are not able to detect the misstatement. 40% of the time it becomes a detection risk. So when I compare, say the risk of material misstatement, which is 10%, and detection risk, which is 40%. So when I combine these two, I get the answer as 4%. So here in this case, the audit risk is 4%. This is what you have to highlight. So you have to go very systematically. You have to understand what is inherent risk, control risk. The combination of this becomes risk of material misstatement, and then you have to combine with the detection risk to arrive at the audit risk. Okay, audit risk is a risk of giving a inappropriate opinion on the financial statement when you give a unmodified opinion instead of a modified opinion, but the vice versa is not an audit risk. Okay, thank you very much.